Okay guys, so now we are going to focus on the final part of chapter 4. Okay, so for the final part of chapter 4, what we are going to do is we are going to go into the details. Okay, we're going to drive down into the details of overtrading. Okay, so I've mentioned to you that after I've taught you overtrading, we are going to do about one question, and I will give you one question for you to try yourself at home. Use the same concept, use the same formula that I'm going to teach you, and trust me, I am very, very sure that you guys will be able to complete this question easily. Now, just want to remind you guys, examiner has mentioned that students find this area particularly difficult and they are unable to understand and they are unable to calculate over trading of a company. They are also unable to assess whether a company is over trading. So in that sense, what is important is that you guys must know, number one, what is the concept, definition, and meaning of overtrading. Subsequently, you must know how do you identify whether a company is overtrading or not. And following that, you also need to know how do you do or perform the calculation. Finally, you need to know how do you calculate overtrading and achieve or arrive to the conclusion regarding the overtrading of an organization. Now, I'm going to share my screen first, and subsequent to that, we will talk about overtrading. Okay, can you see my screen, guys? So, overtrading. What is overtrading? How does overtrading work? How will overtrading affect the organization, right? So, overtrading is a scenario where the company has excessive business opportunities, but they do not have sufficient resources to fund the business on a day-to-day basis. All right, another term that you can use for overtrading is undercapitalization. All right, that means, I repeat, the organization has too many business opportunities and they not have sufficient resources to run the organization's businesses. So it is often called as a business trying to do too much, too quickly, with too little long-term capital. So you are not able to carry out your business as usual because you do not have sufficient resources, right? So even if the company is overtrading, okay, but still operating on a profit, that means the company is now considered as overtrading. Too many business opportunities, not enough funds. So as a result of that, too many business opportunities, not enough funds, but the company is a profitable company. Is it still a bad thing? Yes or no? Think about it. Take 1 minute. So when this scenario happens, okay, I'm going to give you the answer. Yes, it is still bad because it actually means that even though your company is a profitable company, you don't have a proper or you don't have sufficient cash to support the business activities. Means you can easily run out of cash, and as such the liquidity of the organization is affected. Okay, so let's highlight a few things here. So overtrading, another word for it is undercapitalization. So it means that you don't have enough working capital to support the business activity, or in other words, the company has too many business opportunities and does not have sufficient resources or cash. Okay, now, so what example can I give you? So assuming a college, let's say you just started a college, your college is providing tuition for the ACCA qualification, and you have so many sponsors that are willing to sponsor your organization. As a result of that, what happens is that your business opportunity now has increased tremendously. But as a result of that, your organization, because it is new, you may not have sufficient resources to fund the business opportunities. Example, you may not have enough lecturers, you may not have enough classrooms, you may not have proper technology, and you can overcome all these problems if you are able to have sufficient cash to run your business. So how do you identify, or what is the indication that an organization is suffering from overtrading issues? So number one, to prove that the company is suffering from overtrading issue, you need to identify whether the company has a tremendous increase in sales. Because a tremendous or a large increase in sales can only mean that the organization now has too many business opportunities. So that's identification number one. What is identification number two? Identification number two is you need to perform calculations on, all the relevant working capital ratios. What does it mean by all the relevant working capital ratios? That means you need to perform calculation on the trade receivable days, the trade payable days, and inventory days. Okay, when you perform the calculation on the trade receivable, trade payable, and inventory days, if you see all your ratios deteriorating, what it means is that the company is suffering from either a lack of cash, or they do not have sufficient resources. They do not have sufficient resources to run their organization. Now, besides that, besides these 1, 2, 3 ratios, you can also calculate the liquidity ratios, because when the company does not have sufficient cash, it is clear that the liquidity ratio of the organization is going to deteriorate. And finally, you will also be able to see that the sales to net working capital ratio does not match. Right now, I've brought you to, or I've introduced you to a new term, sales to net working capital ratio. So I'm just going to run through it again. Step number one, guys, step number one always is to calculate the growth in sales. Always, this will be step number one. Please do not forget that. Number two will be to calculate your working capital elements. Number three, liquidity ratio. And number four, sales to net working capital ratio. Now, before I go in detail on overtrading, I first need to explain to you guys what does it mean by sales to net working capital ratio. So, the sales to net working capital ratio is normally used to identify whether the company is funding their increase in business opportunity with appropriate amount of working capital, right? I.e., it also represents the amount of working capital or the amount of cash that is needed to support a certain level of sales. Okay? Now, so how or what are you required to do when you talk about sales to net working capital ratio? Before I proceed, let me write it down first. Sales to net working capital ratio, it indicates the amount of funds or cash required to support the level of sales of a company. So, for example, if your sales increase by 30%, so you need to pump in additional 30% funds to the organization for you to be able to fund the business operations. Okay, so with that, let's try to do one question. This will be the question relevant to the sales to net working capital ratio, and then after that we will move to your overtrading question. Okay, let me share screen first. Okay, can you see this? This question is also extracted from BPP. Now, the requirement. The requirement here is to calculate. So what is the level of net working capital or cash that is required to support the sales if sales increase by 30%? So how you would do this is you will calculate it using the sales to net working capital ratio. So assuming the sales to net working capital ratio remains the same, and so just quickly to show you how this formula works, sales over net working capital ratio equals to the whatever ratio that you have. If this remains constant, these two can fluctuate. So assuming this remains constant and your sale increase by 30%, calculate how much net working capital ratio will then be required. So now, how much is my sales value? My sales value is $864,000. If my sales increase by 30%, 864,000 increase by 30%, this will be 1,123,200. Okay. Now, you need to calculate the value of X, which is your net working capital ratio. So, 1123 200 divide by x equals to 2.49. What is the value of x? So the value of x is $451,084. That means the conclusion: to fund an increase in sales of 30%, the net working capital required, the additional net working capital required will be, okay, let's see how many percent. So to calculate the percentage of change, it will be 346,400 346,400 over 346,400. So 451 minus 346,400 over 346,400 is a 30% increase. Okay, i.e. Okay, don't put IE, guys, okay? The total net working capital required will be $451,084. Okay? So you must remember, what I'm trying to show you here is that you need to ensure that the amount of net working capital should increase in line with the amount of sales. So if your sales increase by 40%, your net working capital should also increase by 40%. Then it is a like-to-like information. If not, it only means that your company is not putting in enough money to fund the increase in sales. Okay. Now let's move to the overtrading question. I hope you guys are okay. I hope you can understand. I'm going to share my screen, the past year question compilation again. All right. Okay, wait, I think I'm sharing the wrong screen. Just give me a moment. I will just share this. Guys, sorry, just give me a moment because I don't know. I can't find my screen. Sorry, the question compilation. I can't seem to find it. Okay. Okay, guys, found it. Sorry, I'm gonna share the passive question compilation. Okay, can you see this question is called Gorwa? Okay, I'm going to teach you how to do this question, but it is going to be in Excel. The reason why I want to show it in Excel because I want to show you how to perform the calculations, and I'm going to show you how easy it is actually to do it. All right, so scroll down, look at part B. Okay, part B says use the above financial information to discuss with supporting calculation whether or not Gorwa is overtrading. So it's up to you guys to decide whether this company is overtrading. So remember my steps that I told you. Step number 1, calculate increase in sales. Number 2, working capital elements. Number 3, liquidity. And number 4, I want you guys to calculate sales to net working capital ratio. Right, so these are the 4 most important things that I want you to calculate. Now, so let's go up and look at the financial information. So you have all the information readily available: sales, cost of sales, operating profit, finance cost, profit before tax. You have current asset, current liabilities, liabilities, non-current liabilities. You have your share capital, okay, and also reserve. Now, the average variable overdraft interest rate in each year was 5%. So this will be my overdraft interest. The 8% bonds are redeemable in 10 years time. The factor has offered, okay, so these are all factoring arrangement. It is not relevant to our calculation of overtrading. So let's move to the Excel sheet, okay. Right, I'm going to go to a new sheet. Okay, I'm going to dive in deeper inside here. Gorwa. Now, do all your workings first. So, number 1, increase. Sorry, I don't want to use caps. Now, remember to plan your answer properly. So, if you look back at the question, guys, make sure you have a hard copy question, okay, while we are doing this together. You have 2007 and 2006 information. So you're going to populate 2007, 2006. Now, in 2006, there is no information for you to calculate an increase, but in 2007, there is. So how do you do the formula? You take 37400 minus 26720, close bracket, divide by 26720. This will give you the percentage of increase in sales. So it's about 40% there. Okay. Number 2, working capital elements. So you have trade receivable days, you have inventory days, and you have trade payable days. All right, so let's calculate for 2007 and also 2008. So for 2007 first, trade receivable, sorry guys. The trade receivables is 4,600. Divide by your sales, 37,400. Now, please check in the question whether you need to use 360 or 365 days. If the examiner did not mention, we will proceed to use 365 days. Right? Now, sorry, inventory days. Again, 4,600 divide by the cost. So 34,408 multiplied by 365. And finally, the trade payable days would be 4750. So equals to open bracket 4750 divide by 34,408 multiply by 365 days, you get 50.38. So now, even though I did not ask you to calculate the working capital cycle, but don't you agree with me? With the information that you already have, you can calculate the working capital cycle. So I'm just going to do it anyways. Equals to this plus this minus this, right? Okay, now let's do for 2006. So I'm going to assume you guys are going to do it by yourself. I am not going to say anything, but I'm going to show my calculation on the screen so that I'm going to keep quiet. I'm going to assume you're doing it, and I'm going to guide you quietly. Zip, zip, zip my mouth. Okay. Okay, all right, guys. Now, if you get the same answer as me, we can proceed to calculate number 3, liquidity ratio. For your liquidity ratio, I always will tell my students only calculate current ratio. No need to waste time to calculate the what you call that, quick ratio, because it's really not going to make or help in any way. Okay, so I'm going to take my total assets, which is equals to 9,200, divide by total liabilities. Sorry, not total, current asset divide by current liabilities, 7975. For 2006, it will be 4,600 divided by 3,600. Okay, did you guys get the same answer as me? Make sure you get the same answer. If you don't get the same answer, something is not right, right? And finally, number 4, sales to net working capital ratio. So sales working capital ratio. Okay, so for year 1, for year 2007, my sales is 400. My net working capital ratio is, sorry, my net working capital is 9,200 minus 7577976. So sales to net working capital ratio is 30.55. Now, please proceed to do the sales to net working capital ratio for 2006. So the sales in 2006 is 26720. Net working capital is 4,600 minus 3,600. So you can see here, it is not consistent. It should be consistent. If there is an increase, it should be consistent, but it's not. Right? Now, once we have overcome the obstacle of doing the calculation, the next part is to write your answer. So I always tell my students to, whenever you start writing, always remember to write a brief description of what is overtrading. So now, here your introduction will be: overtrading occurs when an organization does not have sufficient capital to support the level of sales. Okay. Okay, as for Gorwa, overtrading can be analyzed using the following ratios. Analyzed using the following ratios. Sorry, I am going to merge this first. Okay. Now, for the next one, I'm going to talk about the increase in the sales. So remember, I always talk about increase in sales first. That's the first thing I say. When I talk about increase in sales, I will say the sales for Gorwa shows a rapid increase of 40%. So that will be your working one. As compared, no, sorry, you cannot ask them to compare because year 2006 got nothing. Okay, you just proceed to say this is an initial indication of over trading. However, the investment in working capital does not match increase in sales. Sorry, I haven't right. The investment in working capital does not match, as the increase there's something not right here. The investment in working capital does not match as the sales to net working capital ratio ratio has increased from 27 times to 30 times. Okay, that means it's not comparable. Okay, but what is the most important part is for you to say that it is an initial indication for overtrading. The next one, let's talk about the trade receivable days. Trade receivable days. Okay, so what are we going to talk about when we are talking about trade receivable days? So I am going to explain whether my ratio has improved or became worse. So let's look at this. My ratio has become worse. Trade receivable days has increased. It's bad. It means that customers are not paying us on time anymore. Okay, so the trade receivable days has worsened from 30 days to 45 days. This is an indication that the receivables are not paying Gorwa Co on a timely basis. Okay, that means they are not paying you on a timely basis. Now, what it also means is that it may also be an indication. That means this may also be a reason why Gorwa Co has been taking on higher amount of overdraft as compared to the previous year. So you can see, so you can say this is definitely an indication that Gorwa is lacking of right. Now for the next one, trade payables. So you can see that your trade payable days has also increased. Okay, go up. I'm sure it increased from 31 days to 50 days. So you can write the trade payable days has also increased from 31 days to 50 days. This can only mean that the suppliers are taking a longer time to pay Orwa Co. This further reiterates that Gorwa Co may be suffering from a lack of cash in the company. Now, the next one, inventory days. So, what are we going to talk about the inventory days? First, let me see what happened to the inventory days. The inventory days also increase, guys. Okay, so the inventory days follows the trend of the other working capital elements and continues to increase. All right, it has increased from 37 days to 49 days. Thirty-seven days to 49 days. Sorry guys, I need to go and double check because I cannot remember. 37 to 49 days. Okay, this means that the inventory is stuck in the warehouse for a long period and Gorwa Co is unable to sell their inventory. However, on contrary, this may mean that Gorwa is stocking up on inventory in anticipation of higher sales in future. Okay, next I'm going to talk about the liquidity of current ratio. So what happens to the current ratio? The current ratio has also deteriorated because current ratio, the higher the better. Now this one has become lower. What it indicates is that, okay, let me just write first. The current ratio has worsened from 2006, okay, or maybe I put has worsened in 2007 and reduced from 1.25 times to, sorry, not times, 1.25 to 1.15. 1.28, not 1.25, huh? To 1.25. This is not a good indication because it only means that the company does not have enough current assets as they used to. In the long run, may affect the liquidity position of the. So you guys, you have already explained all the ratios. Now what is left is for us to conclude. So in conclusion, I just want to let you know that all the ratios have worsened, became worse. Okay, so it is a clear indication that Gorwa Crew is going through overtrading issues. So from the ratio analysis performed, it is clear that Gorwako ratios are worsening as compared to 2006. Hence, can be hence it is clear that Gorwa Co has over trading problems. Now, what else can you continue to say when you conclude? You continue to say, however, this is just an initial analysis. As this is only an initial analysis, a more meaningful and complete analysis can be performed if appropriate benchmarks are available. Wow, guys, do you notice that it is not that easy to do a question like this? Okay, so you need to tell the examiner in detail. You need to perform detailed analysis, detailed calculation, and explain in detail why the scenario has happened. Now, assuming there is a combination of some ratios are good, some ratios are bad, how would you then conclude? So what you write is, if there are a good and bad ratios, you can conclude that and say, there might be over trading issues, or you can say, okay, maybe I write a asterisk here. There is a combination of and bad ratios. What you can write is, you can say that this may be an early indication of over trading for Gorwa Co. Then you continue to say, however, however, this is only an initial analysis. A more meaningful and complete analysis can be performed. So you continue to say that. All right. So this is just in an event where you have a mixture of good and bad ratios. Okay, guys. If you don't have any issues, the next video we are going to talk about working capital management. So I'll see you guys in the next video for working capital management.